Welcome back to Street Smart. Stocks struggling today despite the positive consumer confidence numbers out this morning. Weighing on those equities are financial shares. Banks, including Bank of America, JP Morgan, and M&T, all working together to pull the sector and the S&P lower. To help us make sense of the declines and give an outlook for the group is Gerard Cassidy. He's a financial analyst for RBC Capital. He joins us on the phone from Portland, Maine. Gerard, thanks for joining us. It's interesting because you and I were talking about during the break. Last week there was a survey that said 75% of guys and gals that work at banks are getting calls from headhunters. I think 40% and change are even looking to switch firms this year. So it seems that the banking sector is a hot place to work right now.
I think that's true. And part of the reason, Matt, is that the banks themselves are looking for loan growth. It's very challenging today to generate organic loan growth. So if a bank can go out and hire an energy lending team from Houston, Texas, and plop them right into their bank and they bring their book of business, the loan portfolio will grow for the bank that hired those people. So that doesn't surprise me that it's a high number, but it doesn't surprise me that the banks are aggressively looking to poach other lenders from their competition.
Well, and of course, smart bankers are going to kind of jostle for position. Maybe they're overestimating their value. But the interesting thing then is the juxtaposition of the HSBC story yesterday. They want to cut, and this is a huge global franchise, $3.5 billion in expenses over the next few years, and they're going to do it partially by firing people or laying off staff here in the U.S., among other places. What's the story there? Why do these things not jibe?
I would say they are somewhat similar because the industry is feeling these challenges on revenue growth. And if you're unable to hire new employees to bring revenue growth to your firm, you're going to have to cut expenses. And in fact, we've seen some other banks look to reduce their operating expenses as well. But HSBC is also unique. HSBC is a high-end bank that has a low-end product here in the United States, and I could see why they're maybe downsizing here in the U.S. to try to focus their efforts elsewhere in the high-end market.
How much of a problem, Gerard, is regulation for these banks? There's been so much complaining about the price caps that Congress wants to put on debit card fees, and that's only one of a dozen issues that bank lobbyists have in Washington. What are the big issues that regulators are going to put on banks here in the U.S. and Basel III globally?
I think that this week, the weakness in the bank stocks, particularly amongst our largest banks, similar to what you mentioned, Bank of America, JP Morgan, there is a concern right now that the extra capital that the largest banks in the world will have to carry will be onerous for those banks. Currently, under the new Basel Accords, banks have to carry 7% called Tier 1 common. So the common equity ratio needs to be 7%. There is an expectation that the strategically important financial institutions are going to have to carry more capital. We all believed it was going to be 100 to 150 basis points on top of the 7%. We are now hearing there's a very good chance it could be 300 basis points. That is now filtering into the market. That's what's causing, in our view, the weakness in the large cap stocks today.
Gerard, thanks so much. We appreciate your time. Gerard Cassidy there, financial analyst for RBC Capital.